Hello friends, welcome to another video of the YouTube channel Learn Finance and Accounts. In the previous video, we had discussed about the meaning and definition of cost of capital. Now in this video, we will be discussing about one of the sources of cost of capital, which is debt. So let us have a recap of what is cost of capital. The cost of capital of a firm is the minimum rate of return which is expected by its investors. So these investors can be shareholders, these investors can be the persons or the non-individuals who have granted a loan to this company. The cost of capital used by the firm can be from four sources: debt, preference shares, capital, retained earnings, and equity shares. Today and in this video, we are going to discuss about the cost of debt. The cost of debt is the effective rate of interest payable on debt. It is not the principal, it is the interest. For example, if you take a loan from a friend, say of rupees 100, you return rupees 100 after 1 week, then this is zero cost debt. But if you return 100 rupees, which is was the principal, plus 5 rupees, which is the interest, then rupees 5 is the cost of debt. The cost of debt is the effective interest rate of a company which pays on its debt. So when a company pays interest of 5 rupees, then this 5 rupees is the cost of debt. So it is the cost of debt on loan or debentures. Debentures we had discussed in the previous video. Debentures are issued by a company when they take loan from the general public. So let us discuss about the features of debt. Let us discuss about the features of debt before discussing cost of debt. See, in case of debt, there's a fixed interest irrespective of profit or loss. See, when a company takes a loan and it starts its business operations, sometimes the company gets profit, sometimes it incurs loss. But irrespective whether it is making profit or incurring loss, it has to pay interest to the people from whom they have taken debt. So these people can be debenture holders or these can be non-individuals like a bank. So rate of interest is fixed. This is irrespective of profit or loss. It is pre-decided. So when a company goes to a bank to take a loan, then only the bank tells the company this is the rate of interest that you are going to pay. Similarly, when company raises debentures, then it has to tell the investors that this is going to be the rate of interest that will be paid to you. The second feature is that in case of debt, the return which is being paid, the interest, that interest will give a tax benefit. We all know that when a company raises capital through debt, then what is debt? Debt is a cost, it is an expense. So when we have to calculate the profit of the company, then we will deduct all the expenses. Interest is also known as expense. Interest is also a kind of expense. So when profit is calculated, interest is also debited like other expenses. And now what is left is the profit on which tax is paid. So for payment of tax, interest is not there, interest has already been deducted. So in a way, we can say that there is a tax benefit of raising money through debt. Third feature is no voting right. See, all the debenture holders or all the non-individuals who have given loan to the company, whether they are bank or they are NBFC, non-banking finance companies, or debenture holders. So these people will get a certificate from the company that they owe some in some say some loan to the company. They have given some loan to the company, but they do not have any voting rights. This means that they cannot interfere in the management of the company. Interference in management of the company is not possible. See, when you purchase shares of a company, then you have voting rights as individual, or What do you mean by voting rights? Voting rights mean that when some decision is to be taken by by the management of the company, then you can interfere in that and you can say, no, take this decision, no, take that decision. This you can do only if you have more than 51% of the shares. So if all the shareholders get together and they make 51% and they tell the company to make a particular decision, then the company has to accept that decision. But in case of debt, when a bank gives a loan to a company, then the bank manager will never going to tell you the company going bank manager will never tell the company that you produce this, you manufacture this, or you do trading in this. So bank manager is not concerned, bank is not concerned at all about the functioning of the company until and unless something drastic happens. So there is no voting rights. So this was the third feature of debt. Now debentures can be of two types. They can be redeemable, they can be irredeemable. Redeemable debentures or debt are those which are repaid to the suppliers of debt after a specific period. Irredeemable or perpetual debt is not repaid to the suppliers of debt, only interest is paid and the principal is not paid. What is the meaning of this? Okay, let me tell you this in simple language. Redeemable debt. First, we will talk about redeemable debt. Suppose you have given a loan to your friend 1000 rupees and that you have told that friend that I'll be requiring the money back next month, and the friend promises to give you the money back the next month he comes to you and says, I don't have the principal, take this interest, I will give the principal next month. So next month also he comes back and says, take this interest, I will give principal next month. So this says principal is not paid back, only interest is paid. This is irredeemable. So you can say that your loan is irredeemable. It has not come back. Principal has not come back. And redeemable is that when the friend returns both principal as well as the interest after a specific period, which is 1 month. So this is the basic difference between the two, redeemable and irredeemable. Now we can calculate cost of debt in both the cases. How? See the cost of debt, which is known as KD. Now KD we had discussed about in the previous lecture also, in the previous video also. So KD is cost of debt. And how do you calculate KD in case of irredeemable debentures? So the formula is very simple. It is interest into 1 minus tax rate. Remember, there's a tax saving. So tax rate will also have to be taken into account. And the total amount is divided by the net proceeds or the amount received. What is this amount received or what is this net proceeds? See, sometimes what happens, the company has to incur some flotation cost to get money from the public. And I'll give you here an example of LIC. You all know what is LIC, Life Insurance Corporation. So LIC has various agents, and when a LIC needs money, it tells the agents, okay, we require money. The agent comes to you and the agent says, okay, I will deposit the money which you give to me in the LIC. Agents takes say 10,000 from you and goes to the company and deposit the money in the company. Now the company agent is not doing this as a social service. He or she is doing this because he or she will be getting a return from the company. What is this return? This return is known as commission. So LIC company will give something in return to the agent. Okay, you have deposited 100 rupees, so take 1% or 2%. 100 rupees for 100 rupees, take 1 rupee as your commission. So this commission is returned. It is given to the agent for raising capital for the company. Similarly, when a shareholder takes some brokerage from the company as well as from you, because the shareholder for the broker is taking the money from you as well as the company both. So that brokerage is also a flotation cost for the company. Sometimes what happens, sometimes the legal fees has to be paid by the company to get money. How? Say it is issuing debentures, and for every debenture of 100 rupees, a stamp paper, a stamp, non-judicial stamp of rupee 1 has to be affixed on that certificate. So this is the legal fees that is being paid. Sometimes accounting fees has to be paid. So all this is known as flotation cost. Now this flotation cost is to be subtracted from the face value to arrive at the net proceeds. Face value is the value written on the certificate. Say when the certificate is issued to the debenture holder and the certificate says 100 rupees, then that 100 rupees is face value. But actually, what has the company got? It has not got 100 rupees, it has got say 98 rupees. 2 rupees has been given as commission or brokerage or legal fees or accounting fees. 2 rupees has been given. So the net proceeds that the company gets will be 98 and not 100. 100 is what? 100 is face value. Interest and net proceeds must represent same relationship. That is, if interest I is taken for the whole of the debenture issued, the net proceeds NP of the debt must be the whole of debentures. Similarly, if the interest payment I is taken only for single debenture, then the net proceed of only one debenture is to be taken into account. So this will be used when we are doing calculation. So, what is net proceeds? Net proceeds is also known as amount received, which is equal to face value minus flotation cost minus discount plus premium. Now, what is this discount and what is this premium? See, discount is when the company is issuing debentures and the debenture is of 100 rupees. But people are not purchasing debentures. They do not trust the company, or the company can be new in the market. So they are not purchasing their debentures for 100 rupees. Then the company issues some discount. Okay, we will give you debenture of 100 rupees for 98 rupees or 97 rupees. 3 rupees we are giving as discount. So what is the net proceeds that the company is getting? It is getting the net proceeds which is equal to face value minus flotation cost minus discount. If 2 rupees is flotation cost and discount given is 3 rupees, then the company gets 95. Then premium. We'll talk about premium. What is premium? Premium is say when the company is quite, it has a quite good reputation or a goodwill in the market, and people are waiting for the debentures of the company, and there is oversubscription. Then so many people are there, so they say ki we need debentures, and the company says so many people are there, so we should launch our debentures at a premium. So instead of launching the debentures at a face value of 100 rupees, they will launch at say 102 rupees. 2 rupees will be premium. So net proceeds will be, now it will be higher than 100 rupees because of this premium. But interest is calculated on face value. It is not calculated on net proceeds. It is calculated on face value. Now let us come back to the formula again. Formula is interest into 1 minus tax rate divided by amount received or net proceeds. Okay, so let us do a numerical small question which will make it more clear. So a company issues 12% debentures at par. And what is at par? At par means no discount, no premium. The company issues 12% debentures at par for 2 lakh rupees. Compute the after tax cost of debentures assuming that the tax rate is 30%. Now, in this, the company has issued 12% debentures. This means the interest to be paid is 12%. For every debenture of 100 rupees, 12 rupees will be paid as interest. And the tax rate is 30%. Now, tax has to be taken into account because there is a tax saving on debt. So the solution, how do we calculate this question? So cost of debt, which is KD for irredeemable debentures, will be interest into minus 1 minus tax rate divided by amount received into 100. Into 100 because we are going to calculate as percentage. Now first we will have to calculate interest. How is interest calculated? Interest will be calculated by principal, that is the total amount, into 12% was the rate of interest divided by 100, that is 24,000. Now KD will be calculated as 24,000 into 1 minus 0.3. What is this 0.3? It is the tax, 30% tax rate. So for every 100, zero point 0.3 will have to be paid as tax. So divided by net proceeds, which is 2 lakhs, and 200, which is 8.4%. So that is how we calculate irredeemable cost of debt. Now, what happens in case of redeemable? We knew what is the difference between redeemable and irredeemable. So, in case of redeemable, the formula is somewhat the same. What is the difference? See, first part of the formula remains the same: interest into 1 minus tax rate. Then plus redeemable value minus amount received divided by number of years for redemption, whole divided by redeemable value plus amount received divided by 2, and whole multiplied by 100. So this redeemable value minus amount received divided by number of years for redemption is being added. So now let us do a numerical on this. A company issues 10,000 10% debentures for 10 rupees each. What is this 10 rupees? 10 rupees is the face value and realizes 95,000. So although the company had issued debentures for of 10,000 debentures for 10 rupees, it should have got 1 lakh rupees, but it gets only 95,000. So what is the 5,000 that the company hasn't received? That is the flotation cost. Uh, After allowing 5% commission to the brokers, now this money is being given to the brokers. Debentures are redeemed after 10 years. Calculate the effective cost of debt considering tax rate to be 30%. Now, how will calculate? So this will be the calculation: 1 into 1 minus 0.3 plus 100 minus 9.5. What, why 9.5? Because for every debenture of 10 rupees, the company has received 9.5 rupees, not 10. Divided by 10 rupees, whole divided by 10 plus 9.5 divided by 2 into 100. So the cost of debt in this case will be 7.69%. Okay, so this was all about cost of capital through debt. In this video, we have done numericals also for cost of debt. Now in the coming video, we'll be doing some calculations about cost of equity. We'll be knowing about cost of equity, and we will be doing some calculations. So that's all in this video. We'll meet again. And just to remind you again that this channel is dedicated to the students as well as teachers, so you can take maximum benefit out of this, and so that we can continue making such educational videos, we would want your support. You can support us. So we'll meet again. Please like, share, and subscribe to the channel. Thank you.